Few things are as good in dividend investing as a stock that offers both a high yield and dividend growth. And although they are difficult to come by, some dividend investments do offer a higher than average yield with growth prospects. In this video, we're going to take a look at some investments that not only offer a higher than average dividend yield, but investors should also expect to see their dividends increase within a year's time due to these companies posting some really good metrics. Either that, or I'd expect these companies to pay more special dividends this year, which are one-off payments that are a result of them performing better than expected. Normally, I wouldn't feel comfortable making predictions like this, but every stock I'll mention has a pretty consistent history of growing their dividends, and all of these companies have continued to post really good financials, so I don't see why the dividend growth should stop anytime soon with these. So with that being said, let's get started. The first high-yielding stock that's likely to increase its dividend this year is Sixth Street Specialty Lending, ticker symbol TSLX. They're a business development company that provides senior secured loans, unsecured loans, mezzanine debt, and investments in corporate bonds and equity securities. According to their website, it says, "Our creative financing delivers fully underwritten solutions in a variety of industries and across the spectrum of the capital structure. Our unique portfolio construction allows us to manage a well-diversified, low-volatility current yield portfolio. This approach provides benefits to both our financing partners and our investors." Today, Sixth Street Specialty Lending has a total market cap of $1.9 billion, and they have over $3.3 billion in total assets. Since their founding, TSLX has originated over $31 billion in investments, with an average internal rate of return of 17%. Going back to 2017, the stock has been really successful at not only raising its dividend, but also paying a lot of special dividends. With interest rates still currently being high, they've been able to pay even higher dividends. The reason for this has to do with their investment portfolio, which is almost 100% floating rate debt. BDCs invest in small to medium-sized businesses by offering them loans to expand their operations. Most BDCs issue floating rate debt, which means that as interest rates get higher, the borrowers have to pay the lender more interest. And with interest rates still currently being high, many BDCs, including Sixth Street Specialty Lending, have been collecting record profits, thus rewarding investors with even more special dividends. With this in mind, it looks extremely likely that this company will continue to announce new special dividends this year. Now, there are concerns with BDCs about what the future holds for them once interest rates start getting cut. The truth is, it is likely that many of these companies will likely stop paying so many special dividends or stop growing their regular dividend as often as they have these past couple years. However, I do expect things continue to be pretty good given the fact that the Feds aren't going to just drastically start cutting rates. Everybody's expecting them to gradually reduce rates over time because they know that if they just drastically cut rates, it would cause an intense panic in the market. So when they actually do start cutting rates, it's going to be very, very slow, and they're probably still going to remain pretty high for a while at least. With TSLX's last quarterly dividend being 126% covered, I expect there to still be wiggle room for additional dividends to be paid this year. Their stock currently yields over 8.5%, so a stock being able to grow their dividends and already yielding this high is pretty impressive. A downside to this excellent performance, though, is that TSLX is currently trading at a pretty sizable premium, but that's been the case for this company for a long time because the market is simply willing to pay more for a higher quality stock. Another higher yielding stock that's very likely to grow their dividend this year is NNN REIT, ticker NNN. NNN invests primarily in high-quality retail properties, subject generally to long-term net leases. For more than 3 decades, NNN REIT has generated consistent stockholder returns supported by its strong dividend yield and 34 consecutive annual dividend increases. Originally owned by the American restaurant chain Golden Corral as a way for their employees to invest in the company, in 1994 they branched off from the restaurant and became their own independent company. Today they have a market cap of over $7 billion and they own more than 3,500 properties in their portfolio. NNN is far from being the largest REIT in the sector as they're currently ranked 41st in terms of market cap for equity REITs. Despite that, they've still had an excellent track record of dividend growth and coverage. They're one of only 3 real estate investment trusts that are dividend aristocrats, which are stocks that have been able to grow their dividends every year for at least 25 years. The secret behind this has to do with the fact that they like to hold properties that are more e-commerce resistant, just like other higher quality REITs including Realty Income and Agree Realty. You can see throughout their history they've had an average occupancy rating of 98.1%, which is far higher than most REITs. Last year, 99.5% of their buildings were occupied compared to just 91%, which was the REIT industry average. The top types of properties owned by this REIT include convenience stores, auto servicing centers, and restaurants. These 4 categories make up roughly 49.2% of NNN's portfolio, and although it's less diversified than other REITs, it still resulted in pretty good performance. The share price of their stock has still been underperforming since the pandemic and when interest rates started to increase. but their dividend coverage has remained excellent throughout the past few years. Most REITs tend to aim to have a more conservative payout ratio between 70 and 75% to make sure that they still have some wiggle room. As of last quarter, NNN had an FFO dividend payout ratio of just 67%, which is considered very conservative. The company normally announces dividend increases every July, and based upon these results, it looks extremely likely that this company will be announcing yet another dividend increase this year. Finally, one more stock that'll most likely grow their dividend this year is Hess Midstream, ticker HESM. They're a fee-based, growth-oriented midstream company that owns, operates, and develops a diverse set of midstream assets. Hess Midstream owns oil and gas, and they also produce water handling assets that are primarily located in the Williston Basin area of North Dakota. They were founded in 2014, and today they conduct their business in 3 different segments, which are gathering, processing and storage, and terminaling and exporting. All of their contracts are 100% fee-based, which minimizes their exposure to commodity prices and are long-term, with many extending to 2033. In addition, the stock does not issue a K-1 tax form like a number of other oil and natural gas companies do. They send out a 1099 just like any other dividend stock. Hess Midstream is a relatively new company in this field, but that's because this company is a spin-off of Hess Corporation. They're a large internal energy company based in the US that's involved in crude oil exploration and natural gas production. In 2017, they spun off HESM into its own business, which is pretty small in comparison to some of their peers, including Energy Transfer, Enterprise Product Partners, and Kinder Morgan. But despite being smaller and newer, HESM has been a great performer up to this point. They're projecting an increase in adjusted EBITDA of 10% every year up until 2026, which is around what they've been seeing up to this point. Hess also is projecting free cash flow growth of roughly 10% each year, and they say that they have the ability to significantly grow their FCF after distributions also. Free cash flow is the money a company has left over to pay dividends, so seeing this number go up is a really good sign. It doesn't guarantee dividend increases, as the company could use this money for other purposes, but it shows that a stock can produce dividend growth if they want to. And fortunately, this company has an excellent track record of prioritizing dividend growth. The company has grown its dividend almost every single quarter since their IPO in 2017, with them only missing one so far. From a financial perspective, the company continues to post some really great revenue growth. And again, because they operate as a fee-based company, their profits are not correlated with oil prices, which is also great. Looking at their share price, their stock has remained relatively flat for the past few years before picking up last year. HESM is currently up over 20% from this time a year ago, which shows the market is finally catching on and is gaining confidence in this company's performance. Currently, HESM is offering a dividend yield of over 7% and is another good example of a high-yielding stock that's done really well with continuing to grow their dividends over time. And that's going to conclude our look at 3 stocks that offer both high yields and a dividend that'll likely be increased within a year's time. Again, I don't normally make predictions like this, but these 3 companies have done so well that I don't see any reason to believe that they won't stop growing their distributions. Be sure to do your own research before making any investment decision for yourself, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.